Hey, what's going on YouTube? Since the Federal Reserve announced that they would be increasing the federal funds rate back in 2022, mortgage interest rates have skyrocketed to nearly 8%, which is a 20-year high. Now, yes, the increase in interest rate has significantly slowed down the rate of inflation, but it also has caused an affordability crisis amongst many home buyers. So in this video, I'm going to share with you 3 different ways that you could get a 4% mortgage rate in today's market, just in case if you're thinking about buying a home in the next 24 months. Now, my name is Art Smith. I'm a licensed mortgage loan officer. So the tips and strategies that I'm going to be sharing in this video are not theory. Matter of fact, they are actual strategies that you can implement starting today that could help you get into a home that you could call your own. Now, let's jump right into it. Strategy number 1, assuming a 4% mortgage. An assumable mortgage is a type of home financing that allows the buyer to assume the seller's existing mortgage rather than take out a new loan on the existing property that is for sale. You as the home buyer will essentially step into the seller's shoes, taking over their existing loan balance, interest rates, and the repayment schedule of the original mortgage. Now, this works very well if the current seller of the property has very little equity in the home and they cannot get rid of the property at the desired amount. And since the interest rates have skyrocketed to a 20-year high thanks to the Federal Reserve, many home sellers cannot find buyers for the homes that they're looking to sell. This not only presents a unique opportunity for you to assume their mortgage, but also to capitalize on the savings of their mortgage. Now, not all mortgages are assumable, so here's a list of mortgages that are assumable. FHA loans, VA loans, and USDA loans. However, FHA loans are going to be the most popular for this strategy. Now, of course, there are many benefits to assuming a low interest rate loan. However, there are some things that you need to consider. 1, while you're taking over the seller's existing mortgage and repay that over time, you're only assuming their outstanding balance. So you'll also need to pay the seller the difference between the purchase price and the existing loan amount, either out of pocket or with another loan. And 2, you'll still have to qualify for the assumable loan by having good credit and also having 12 to 24 months of documented income so that you can meet the lender's qualifications and debt to income ratio. However, if you could cover the difference and still qualify for the assumable loan, this is a great option if the opportunity presents itself. Strategy number 2, permanently buy down the interest rate. Now, buying down the interest rate on a mortgage involves paying the lender an upfront fee in exchange for a lower interest rate. An example of what this might look like is if you are quoted a 6% interest rate to buy a house with no additional charges for that 6% interest rate, the lender might offer you a 4.5% interest rate in exchange for $5,000 in additional costs or loan charges. Now, the additional charges, also known as the rate buy down, can be paid by you as the buyer, the seller, the real estate agent, or even the lender. However, there is one thing to consider, and that one thing to consider is that the loan charges cannot exceed 3% of the total loan amount. Loan origination charges include fees like underwriting fee, origination fee, lender fee, processing fee, and also the cost to buy down your rates, also known as discount points. And if the total of all origination charges exceed 3% of your loan amount, then unfortunately your loan will not get approved. So it's important to understand this one lender requirement. And the reason why I bring this up is because if you plan on buying down the rate on a home loan, it is best to find a mortgage program with a starting APR or interest rate as close to 4% as possible. So here are a couple of loan programs that have a starting interest rate in the 5%. 1, the NACA housing program has a starting interest rate of 5.625% for a 30-year fixed rate mortgage at the time of me shooting this video. NACA is a great program that helps lower income earners and minorities become homeowners. However, anyone can apply. 2, Navy Federal Credit Union has a conventional loan with a starting APR of 5.25% for a 15-year fix and a 3-5 adjustable rate mortgage with a starting interest rate of 5.625%. So if you could find mortgage programs just like these, then buying down the interest rate into the 4% becomes more achievable. Strategy number 3, take advantage of a 2-1 buy down. A 2-1 buy down is a mortgage agreement that provides a low interest rate for the first year of the loan, a slightly higher interest rate for the second year of the loan, and then the full rate for the third year of the loan, and so on. Think of a 3-step staircase. Every single year after the first year, your interest rate will progressively get higher. 4% for the first year, 5% for the second year, and 6% for the third year and every year thereafter. And the great thing about a 2-1 buy down is that this is a strategy used by sellers and home builders to incentivize home buyers like you to buy a home. And since they offer this as an incentive, they also cover the cost of the 2-1 buy down. Here is an example of a mortgage with a $320,000 loan balance and a 30-year term. As you can see right here, the first year you'll have an interest rate of 4.125% with a principal and interest payments of $1,550 a month. Then on year 2, your interest rate will increase to 5.125% with a payment of $1,742. And year 1 through 30, your interest rate will be fixed at 6.125% with a payment of $1,944 a month. Now the total cost of the buy down for this example is $7,145, which will be paid by either the seller or the seller's agent. Although the rate buy down is temporary, this strategy will allow you to get a mortgage in the 4% starting off and allow you to save more money the first and second year of your mortgage. And there is nothing stopping you from refinancing out of this loan in the future as rates start to naturally come down. All right, guys, you could use any one of these 3 strategies to obtain an interest rate in the 4% even in today's market. And if you haven't done so already, please subscribe to this channel and like this video if you found value in it. And if you're not ready to purchase a primary residence, also known as a home to live in, but you still want to jump into real estate, watch this video right here on how to buy and fund your very first rental property as a complete beginner. Thanks for watching to the very end, and I'll catch you on the next video. Goodbye for now.